Hi, I'm Jay Soul, Morgan Stanley's branded apparel and footwear analyst, and I'm very pleased to be joined again by Pam Goodfellow, Consumer Insights Director for Prosper Insights and Analytics, one of the leading market research firms in the US. And today, here in part 2 of our video, we're going to talk about why consumers are spending the way they are in September. In the first video, we talked about what they're going to spend on. Here we're going to talk about why. And I think the key take here is that even though confidence is up, and your data shows confidence is up, consumer spending habits have changed. In economics, they say, the ability to spend is up, incomes are up, job growth is up, but the willingness to spend is not quite there. And you have some very interesting data that shows that. So first, let's talk about consumer confidence. I mean, your data shows that confidence is up. Is that right?
That's correct. We measure confidence on a monthly basis, and this month we're showing that about 45% of consumers say they're confident or very confident in chances for a strong economy. It's a great percentage. It's the highest percentage we've seen since October 2007. So this is the best reading since the recession. I say that with some caution. This is the first month we've seen a reading that high, so there's always a chance we could wobble in the next few months, but so far so good.
And Pam, you're also seeing that lower income consumers have seen their confidence increase. A lot of talk in this kind about the lower income consumer has struggled. Talk about the confidence of the lower income consumer.
Right. This is the first month since the recession that the confidence of the low income consumer has exceeded 40%. I think that's a great marker there for their confidence. We haven't seen that since before the recession. This was the income group that really slid down during the recession. So to see them kind of pop back up and gain a little bit more confidence is encouraging.
All right, so here's the interesting thing. Confidence is up, and normally in economics we would expect that if confidence is up, people show a higher interest in spending, and they do spend more. Mm-hmm. But something has changed since the financial crisis. And we can see it when you ask these behavioral questions of people. And one is, are you becoming more practical in how you're spending? Can you talk about what you're seeing from people when you ask them about their practicality in spending?
Sure. We track practicality in spending and also focus on needs when you're at the store. So these very budget conscious, pragmatic approaches to spending. And we're showing about 2 in 5 consumers in both buckets are still focused on practicality and watching what they spend. Now that's dropped a little bit since the height of the recession in about September 2009, we're talking. But it hasn't recovered to where we were before the recession. So consumers are still seeing these kind of heightened levels of practicality. It's really the new normal. Consumers have a better capacity to spend compared to a couple years ago, but it's the willingness has to be there, and they don't feel compelled to spend quite like they did before the recession.
Interesting. And we also talk about the wealth effect. The stock market is up. We're near all-time highs. Yet it doesn't seem that the wealth effect is flowing through to retail. Now, you ask a very interesting question about how people feel that the stock market is indicative of what's happening in the real economy. Talk about that. And what are people saying to you about how they feel about the stock market?
Right. Well, I think consumers are a bit jaded by the stock market, I guess. Right when the financial crash happened, more than half of consumers blamed the stock market for what was going on in the economy. But that number has really tapered off in recent years and has floated about 33%, for the past couple of years. So it doesn't feel, I don't see the bull market really affecting confidence. So consumers were quick to blame the stock market for what happened when the economy was going bad, but they're a little hesitant to look to the stock market to kind of as an indicator of economic growth.
Interesting. And then maybe one more thing is on the savings rate. The savings rate is always a big topic. If the savings rate goes up, it's a big headwind for retail sales. You ask people on a regular basis, do you plan on saving more, saving less? What are people saying about their intentions to save rather than spend in this economy?
Yeah, savings is still a key priority for consumers. We actually saw our savings indicator, not only has it gone up since September 2009, so during the recession, but also it's up compared to September 2007, so before the recession. So consumers are more focused on savings than they have been in recent years still.
Interesting. So the question is, looking forward, how long is this trend going to persist? Because presumably at some point people get more confidence, they start spending, buying on credit. It seems like the trends show that people feel like they're saving as much as they need to, based on history. But what's your sense of it? Are we toward the end of this cycle, or is it going to last for a while?
It's really kind of hard to gauge at this point. It is the new normal, and we're still trying to kind of figure out where consumers' headspace are, especially concerned with savings, because it remains such a priority. Before the recession, I think consumers felt like maybe they were saving enough, but having gone through the recession and seen some hard times, I think they'll probably, save at a rate higher than what they were, just simply so they don't go back to where they felt they were back in 2008, 2009.
Interesting. So I think for the stock market, I think the important takeaway is we continue to see an environment that's good but not great. A rising tide that's not good enough to lift all boats. So that's why we're sticking with our secular winners and best executors. And I think this kind of all feeds into what we're talking about. So very interesting. Why don't we stop there? Again, I'm Jay Soul, Morgan Stanley's branded apparel and footwear analyst. This is Pam Goodfellow, Consumer Insights Director for Prosper Insights and Analytics. Thanks so much for your time.